Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Hi, everyone. I'm Erin Allen. Welcome back to ETF Market Insights. In case you missed it, last week I did my first ever Reddit AMA, which stands for Ask Me Anything, where I dove into your questions, anonymous questions from our community on all things ETFs. And I thought there were some really good questions, some tough ones at times. And I wanted to sort of bring them on this channel and rehash some of them for you here. I sort of picked the ones where either there was the most engagement or I just felt that other people would be asking this question. So we're going to dive into sort of a recap of the AMA. Before we get started, a quick reminder that I'm not providing investment advice or tax advice for that matter. Today is all about education and for just my perspective on your questions. So let's dive into what I felt were the top or most popular questions of the AMA. First up, I want to take a look at this one that was all about leverage. This person is looking to take on more risk in their portfolio, and they were asking about ETFs, also known as leveraged ETFs. They also mentioned they were a newer investor. So here's my take on this. For those of you who might not be familiar with leveraged ETFs, they aim to deliver usually 2 or 3 times the daily return of the underlying. So that could be an index, it could be a commodity. Some even offer inverse exposures, so -1 times or -2 times, which really attempts to provide returns if markets are to drop. These are traditionally swap-based or futures-based. And as the individual alluded to, they are a way to add risk to your portfolio. They are a way to amplify returns if you have conviction in a particular area over the shorter term. But what I caution investors is that they also do the flip side. They also amplify any losses in your portfolio. So always remember that and be comfortable with that. And then the other thing I really wanted to stress in my answer to this question was that these are not a buy and hold strategy. We've seen a lot of investors that will hold on to these for a year, 2 years, 3 years. And what these are really daily reset products, meaning they're designed to match that index or commodities performance up to their selected levered amount for that day only. So over longer periods, you can see compounding and volatility really begin to lead to different results than expected. And this is because they're based on derivatives. So what I suggest for newbies, as this person said that they were, is to start small, start with a small portion of your portfolio, or even better, get started on like a paper account, a fake account where you can start trading these products and really see how they're going to react. So again, leveraged ETFs carry more risk than their non-leveraged counterparts. So be aware that you're also going to get the amplified downside as well. And as always, read the prospectus on these products and make sure you're understanding all the risks. The second question I wanted to highlight, and we did get a bunch of questions on asset allocation ETFs. I've picked a few. This individual was asking if they should buy the all-in-one ETF or build their own portfolio. So of course, I can't give specific investment advice. I know nothing about this individual's investment goals, time horizon, or financial situation. But I can share how I really would think about both approaches based on my experience and sort of give an idea in terms of the pros and cons of each. So asset allocation ETFs, for those who are starting out, I think these can be a great option. They're simple, they're low cost, and they automatically are diversified across different stocks and bonds and geographies. The big thing also is that you don't have to worry about rebalancing. Rebalancing can be a really emotional decision for investors because what we're doing in effect is selling our winners and adding to our losers. And this is hard for most of us. So they do really automate that for you as well and take the emotion out of it. The trade-off with an asset allocation ETF is that you have less control over the exact mix of your investments. So on the other hand, if you were to go out and build your own portfolio, this is really giving you a lot more flexibility. You can choose different ETFs based on regions, sectors. You can add themes that interest you. But what it does do is it takes a lot of your time. It takes greater investment knowledge, and it takes greater effort to manage and rebalance these allocations over time. So you can do either one, whatever works for you, really. Another thing I've heard investors say is that they like to do it themselves because they can take an asset location approach to their investments, where they can put the less tax effective ETFs in their registered plans and keep those more tax efficient exposures in their non-registered account. So again, in my opinion, starting with an asset allocation ETF is a solid move. It doesn't mean you're set with a strategy for life. You can always change your approach as you get more comfortable and knowledgeable in different areas of the markets. The next question, another asset allocation ETF question. They said, I just buy ZEQT, which is the BMO All Equity ETF, but is that tax efficient for non-registered accounts? So this sort of ties into the last question. Again, I need to highlight, I am no tax expert, so make sure you're consulting your tax advisor or financial advisor on this front. But what I can say is we can look historically at ZEQT and how the distributions have looked historically based off of what they were holding at that time, of course. And you can do this yourself by going to any ETF issuer's website and going to taxes and distributions and then pulling up a previous year to see the breakdown. So ZEQT, it's an all equity ETF, globally diversified. It will give you Canadian dividends, which benefit from the dividend tax credit. There's about 25% in Canada. It will give you foreign dividends. These are taxed at your full marginal rate, and it will give you capital gains, which are taxed at 50% of the gain. So while ZEQT, being all equity, is going to avoid the interest income from the fixed income side of your portfolio, it does still pay out a distribution. You are still going to be taxed on this. It's very hard to avoid the tax man. But I encourage you, again, to look at the ETF's website historically to sort of measure and give you an idea in terms of how that looks from a tax perspective. The next question was about getting kids interested and comfortable with investing. I think that's why, because I said I was a mom in my AMA pitch, I got a lot of questions on RESPs and how to get kids interested in investing. And if you missed it, we did do an episode on ETF Market Insights. I think it was 2 months ago now, piggy banks to portfolios, where I had two guest speakers who are experts in getting your kids interested in investing. So I encourage you to watch that. But from my perspective, my own personal experience, I've found that just keeping it fun and relatable is the best way to get kids interested. So we started by getting ours interested in picking stocks that they recognize. So in my youngest daughter's case, that was Disney. In my oldest, it was Starbucks and Lululemon, of course. And we just tracked how those stocks performed over time. So a couple times a year, I'll just pull it up and walk them through it. It's not every month or anything. And I'll show them how much their money is growing. And they're really interested in it. So just start small, start with things that they can relate to. There's also some really great apps out there for maybe older kids, more technologically inclined, where you can play around without using real money, which could be good. And for newer investors, they can learn mistakes without real money on the line. And there's also some great books I encourage you to read and check out that past episode that I just spoke about. They also asked about RESPs and what investments they should put in an RESP. Again, there's no one perfect answer for this, and I don't have the full situation, nor am I a financial advisor. It depends on your comfort level with risk, your family's sort of financial situation. But generally speaking, when you're starting with an RESP, you do have a longer time horizon. So people tend to lean into a little bit more growth-oriented exposures, like an all-equity ETF, for example. And then they might shift those to become more conservative as they approach that time for withdrawal at the education for university, of course. So again, asset allocations, I think, are an excellent tool because they allow you to get more conservative over time and sort of allow you to have a set it and forget it approach. I don't think an RESP is something people want to be looking at every month and actively trading. Maybe you do. That's up to you. But for me, it's just an all-in-one ETF that I put in every month, and I don't really look at, and eventually I'll move it to more conservative as we get closer to our time for withdrawal. The next question was around fixed distribution or T series ETFs. So we have two T series ETFs, ZBAL.T and ZGROW.T. It's the BMO Balanced ETF and the BMO Growth ETF T series. And these are a newer invention in the ETF space that we've basically stolen from the mutual fund space. So T-series exist. They're a fixed distribution. They pick a percentage. In our case, we've targeted a 6% distribution yield. And the investor was asking, how confident are we that this is a sustainable yield long term? Why did we choose 6% for our T-series? And what happens if this turns out to be unsustainable? So I think this is a really big question, and there's a lot of education that needs to go on in our industry around distribution yields in general. But the purpose of a T series is that it's designed for investors who do rely on that consistent monthly income, particularly people like retirees or those just transitioning from the accumulation phase. And the 6% distribution rate was really designed to strike a balance. It's substantial enough to support what has typically been coined as, the average retirement income need, yet it's conservative enough to make sure we're not completely eroding the NAV over time. This rate is also widely adopted in the mutual fund space, which has been around for years and successful in that area. So that's why we chose the 6%. When it comes to sustainability, in years that the ETF is not generating that 6% return, the distribution will include a component of ROC, return of capital. And this is really to ensure that investors get that steady payout. And it's sort of aligning with the thought that these investors are going to be drawing on their investments anyways during retirement. So we just want to give them the simple solution that gives them that consistency. But yes, you're right. It could include a component of ROC if the ETF is not generating 6% yield. One way you can look at this is, again, going on the ETF issuer's website and looking historically at the tax section at the breakdown. And you can see, historically speaking, how much of that distribution is made up of ROC. What I will caution you on is that there could be a component of ROC that is good ROC, that is simply there because we've smoothed the distribution over the year. But it does give you sort of an indication in terms of how much that ETF has earned. The investor in this situation on the AMA actually came back and said that they would really like to see ZEQT, the all equity ETF, as a T series. They felt that there's a lot of research that supports staying in 100% equities during retirement. So that's something that I've taken back to your product team to think about. So if you do have questions or comments on our product line, I always encourage you to drop them in the comments below or reach out to us because we listen and we'll deliver what investors are asking for. The next question was somebody who's newer to investing and would love to know how they should pick an ETF. What criteria should they be focusing on? And I thought this was one that we had to touch on because I'm sure a lot of you are feeling this way. There's hundreds of ETFs out there, 45 issuers of ETFs in Canada. How do you determine what issuer to look at, what product to buy? So I get that this is overwhelming for a lot of investors. So let's run down sort of the thought process here. First and foremost, you're going to start with your investment objective. You're going to define what you want the ETF to do. Do you want a growth ETF, an income ETF? Are you looking for capital protection, diversification? Define what you're looking for. Then you're going to figure out your risk tolerance and the risk level of the ETF. So check the ETF's risk rating on the issuer's website. This will help you determine sort of the expected volatility of the ETF over time. Check out the ETF's costs. This is a big part of the due diligence process. And what I will stress is that you should be looking at the MER, not just the management fee. Some ETF issuers on their website may only show the management fee, and you'll have to dig a little. So where you can always find the MER is on the ETF facts document. It's a regulatory document that's on every website, so it might require a little bit of digging, but this will give you the more fulsome picture of what you're paying to own that ETF. Another thing you should be looking at is the track record of the ETF. not just the track record of the ETF, but the track record of the ETF issuer as well, I should stress. Has this issuer been around for a while? Do they have many different products? What does the track record on this particular ETF or this index look like? And again, on the issuer front, one thing that we see a lot on Reddit is that investors are considering whether the ETF provider is Canadian domiciled. Is it a Canadian company that you're supporting at the end of the day? So maybe that matters to you too. There's a lot of ETF issuers out there. Are they Canadian made, like BMO ETFs? And then last but not least, make sure you're looking under the hood at the holdings and at the methodology of the product or the index it's tracking. The beauty about ETFs are that they're super transparent. So you can see everything on the website. Check out the prospectus, read the prospectus there as well. And then I also highlighted our tools. So we've talked about these a lot on the channel as well, but we have an excellent ETF comparison tool that looks at the entire Canadian listed ETF universe. So not just BMO ETFs. So make sure that you are doing your comparisons on there as well. The last question I wanted to touch on was a question about liquidity. So this investor was asking about the liquidity of their ETF relative to its volume. A lot of people on Reddit comment that ETFs have low volume, and then that means they're not liquid and you shouldn't buy them. So I wanted to clear that up, this whole question of does trading volume of an ETF affect liquidity? And this is probably the most common misconception I see out there about ETFs. ETF liquidity is a lot more complex and robust thanks to an ETF's unique structure. So ETFs are supported by authorized participants and market makers. And this is sort of what we call the second layer of liquidity, which is unique to unique to ETFs, different from stocks. And these intermediaries can create and redeem ETF shares in large blocks. So they use the underlying securities to create and redeem and make new units of the ETF. And this allows ETFs to absorb sizable buys and sell orders, very easily, even if the ETF doesn't trade frequently, by tapping into the liquidity of the underlying assets. So with that said, a better way to judge liquidity is by looking at the liquidity of the underlying exposure itself. Is the ETF investing in large cap US equities? You're going to have lots of liquidity because the market maker can support you there no matter what the volume is showing. The other thing you want to look at is the bid-ask spread. So a narrow spread usually means it's easy to trade. ETFs that hold, again, popular stocks or large cap stocks are traditionally going to have a tighter bid-ask spread. So check that out as well. But again, trading volume reflects how often an ETF trades hands. It's not how easily it can be traded. So make sure you're not just looking at the volume when it comes to liquidity. Okay, that sums up a recap of last week's Reddit AMA. I hope you enjoyed it, and I hope you'll join us next week. Thanks very much for being here. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.